Welcome to the Daily AI News Digest. This broadcast is sponsored by bestai.org. Today is June 8, 2026, and we're analyzing the market realities and structural shifts currently shaping the technology sector. We'll be cutting through the noise today to focus strictly on the data and strategic corporate movements. Let's get right into the top headlines.
First up, out of Apple's Worldwide Developers Conference in Cupertino, the company is outlining a fundamental structural shift for iOS 27. This is anchored by an estimated $1 billion annual partnership to integrate Google's Gemini models directly into Siri.
Next, we're tracking new macroeconomic data from Bain & Company. Their mid-year report points to a severe disruption in private equity software portfolios. They're seeing an abrupt collapse in technology deal values as capital markets reprice legacy assets. And finally, a strategic realignment from Microsoft at Build 2026. The company is launching a suite of proprietary, in-house AI systems, a clear move to actively reduce its reliance on third-party foundation models.
Let's start with those developments at Apple. $1 billion. That's the estimated annual value of their cloud and technology partnership with Google. It's a highly pragmatic infrastructure decision. By leveraging Gemini to power Siri, Apple is effectively acknowledging exactly where frontier model capabilities sit in the current market.
Operationally, the reality for iOS 27 is that Siri is being completely decoupled from its legacy architecture. It's becoming a standalone application. Through a new framework they're calling extensions, users will be able to route their queries selecting either Google Gemini, OpenAI's ChatGPT, or Anthropic's Claude as their default assistant.
Shifting to global physical infrastructure, the scale of these builds is changing dramatically. Over in South Korea, NAVER has finalized an agreement with NVIDIA to construct a 1-gigawatt sovereign AI factory. They'll be starting with a 55-megawatt initial footprint in 2027.
We're seeing a much broader market trend here. As NVIDIA CEO Jensen Huang noted, with NVIDIA DSX, we can help Korea scale sovereign intelligence infrastructure for the agentic era. It's a strategic international pivot toward localized computing. Governments and regional enterprises are now prioritizing physical infrastructure inside their own borders, rather than relying on centralized foreign clouds to manage their autonomous workloads.
Looking at late-stage private markets, capital flow remains highly targeted. The market intelligence platform AlphaSense just closed a $350 million funding round. That pushes their post-money valuation to a very substantial $7.5 billion.
But we can ground that $7.5 billion valuation in concrete unit economics. AlphaSense hit a critical milestone in the first quarter of 2026. They surpassed $600 million in annual recurring revenue. It's a clear data point showing that enterprise adoption of these specialized platforms is driving tangible financial performance, not just speculative value.
On the product front, Microsoft is making a drive for self-sufficiency. At Build 2026, they launched 7 proprietary in-house models under the MAI banner, which stands for Microsoft AI. It's a deliberate hedge. By developing their own competitive systems, Microsoft is systematically reducing its strategic dependency on that massive $13 billion investment it made in OpenAI.
The MAI lineup targets distinct enterprise workflows. You have MAI Thinking 1, their reasoning flagship, which matches top models on software engineering benchmarks. Then there's MAI Code 1 Flash, a lightweight 5 billion parameter model built directly into GitHub Copilot for low-latency coding. And MAI Image 2.5, which is currently surpassing competitors on the Arena leaderboard for image generation.
We also need to look at the rapidly shifting pricing dynamics across mid-tier and open-weight models. Chinese labs are applying severe downward pricing pressure. For example, Alibaba's Qwen 3.7 Max is operating at roughly half the input cost of Claude Sonnet 4.6. And Minimax drops the floor even lower. For companies running high-volume agentic workloads, this cost differential is becoming a primary driver of their infrastructure choices. Meanwhile, NVIDIA is making a calculated push to bypass cloud latency altogether. They've announced the RTX Spark Superchip, which is an ARM-based processor designed specifically for laptops. By moving directly into Intel and AMD's traditional territory, NVIDIA aims to process autonomous agents locally on edge devices. This could fundamentally restructure the client compute hardware market. Turning to regulation and policy, U.S. Congress has unveiled a 269-page discussion draft titled the Great American AI Act. This represents the most comprehensive federal framework we've seen proposed to date for governing foundation models. The regulatory demands here are strict, specifically targeting companies exceeding $500 million in revenue. It mandates public governance frameworks and formal safety incident reporting. But most critically for the legislative landscape, it contains a provision designed to explicitly preempt and freeze any upcoming state-level regulations for 3 full years.
Shifting back to macroeconomic data, let's look closer at that mid-year report from Bain & Company. They detail a severe disruption currently facing private equity portfolios. They've termed this the Saaspocalypse. What we're seeing is a distinct recalibration of exactly how software-as-a-service assets are valued in the marketplace.
The cold business reality is a 70% collapse in technology deal value from the fourth quarter of 2025 to the first quarter of 2026. The sheer uncertainty surrounding future revenue models has essentially frozen major software acquisitions for the time being.
And there is a stark regional disparity in the resulting valuation markdowns. During Q1, general partners actively wrote down legacy software assets. The U.S. market saw private software valuations decline by 8.9%. In contrast, the European market was more insulated, experiencing a decline of just 4.2%.
Private equity is responding by focusing heavily on controllable factors. Operationally, general partners are extending their holding periods to an average of 7 years. They're also aggressively rotating capital toward businesses that possess hard physical assets or those that are completely shielded from immediate software disruption.
It's time for the analyst's take. When you synthesize this Bain's report with the proliferation of coding and agentic models, the structural reality for the industry becomes very clear. We're observing what analysts are now calling the seat-based extinction. Cutting through the marketing noise, the tension we are seeing is a permanent structural shift. Legacy software relies on per-seat licensing, charging a recurring fee per human user. But as autonomous agents increasingly execute workflows on a per-task basis, fewer human seats are required. This directly breaks the traditional revenue scaling model for enterprise software. Frankly, it's the exact catalyst for the private equity write-downs we just reviewed. We need to conclude this analysis by addressing the hard physical limits of all this technological growth, which comes down to power generation. We are seeing a very clear signal of this friction in Arizona right now. The public utility there has proposed a 45% electricity rate surcharge specifically targeting data centers, just to manage the massive energy draw of these computing facilities.
Looking ahead, the market is watching several key milestones closely. SpaceX will price its $75 billion IPO on June 11th. The Colorado AI Act is scheduled to take effect on June 30th, assuming federal preemption doesn't happen first. We're also seeing institutional investors waiting on Anthropic's public S1 prospectus while developers are tracking the leaked releases of Claude Sonnet 4.8 and GPT 5.6.
That concludes our analysis of today's data and the structural shifts across the market. As we sign off, it leaves us with a critical question to consider. How exactly will the transition from per-seat licensing to per-task execution reshape your organization's software overhead this year? Thank you for joining us for this explainer, and a reminder to visit our sponsor, bestai.org, for further resources.